This meeting is now being recorded.
Hello again, everyone. My name is Stevie Valdez, Senior Associate at the Global Alliance for Clean Cook Stoves. Thank you for joining us for this webinar on building a quality financial model for your Spark Fund application. For this webinar, we will be having two presenters from IDEV International, and I'll let them present a bit more on IDEV and their work. But we'll have first Jason Spindler, who's the Managing Director of IDEV International, talk a little bit about what will be discussed in the webinar, and then we'll have his colleague Patrick Watson join us to discuss the financial model itself and the template that is provided for you on the website as part of the Spark Fund application packet. Before we jump into that, I am going to go ahead and just go over some webinar etiquette. For your information, all guests are going to be muted or are currently muted to avoid background noise. If you do have any questions, please go ahead and place those questions in the chat box to the left or the Q&A button at the top of the screen. We will use or work with the questions and answers more towards the end of the call, and we'll do our best to direct those and get all of the questions answered. Again, this is being recorded and it will be uploaded to the website and YouTube page. It usually takes a few hours for that recording to generate, so we can expect that that will be up on the page tomorrow. In addition, if you've registered for this webinar and provided your email address, we are able to send the slides to the email address. However, with this webinar, it is going to be a bit more interactive in terms of just demonstrating and walking you through the financial model template. So we can't promise there's a lot to see from the slide. We would recommend taking a look at the recording. But as always, if you have follow-up questions to this, you can email us at investment.cleancookstoves.org. And with that, I think I'm going to go ahead and see if we can get Jason Spindler speaking on the line. Jason, can you go ahead and hear us and let us know if you are connected? Okay. Jason, if you can go ahead and speak, I think I've unmuted your line.
All guests have been unmuted.
Okay, Jason, you should be able to speak now. If I can ask all the other guests to please mute your line while we wait for Jason to speak.
Hey, Stevie. Can you hear us?
Hi, Jason. I can hear you great. Thanks.
Great.
So we have gone over those first two slides with the webinar etiquette. We're just waiting for the overview of what's going to be discussed and let you guys take it away.
All right. So I'll go ahead and share my screen now with the last couple of slides, just to give the brief overview on what we're discussing and what everyone can expect. And then I'll actually pass it over to Patrick to go through the financial model itself. So, Stevie, are you guys able to see the screen and the PowerPoint on the screen?
Yes, we can see everything perfectly. Thank you.
So there should be slide, it's the third slide in the PowerPoint. Slide 4 actually is the number on the bottom. It says general information.
Yes.
Okay. So, Stevie, as I'm sure you introduced as we were kind of getting dialed in and dealing with the technical issues, the financial model and financial section is a very important portion of the Spark application. As we've mentioned on past webinars and within the RFP and in the executive summary and application packet, one of the goals of the Alliance and one of the things that I was asked to help work on was help this process, the Spark process, really prep businesses that are going through it for investment readiness. So we've tried to design the entire process from all of the application materials to the way the due diligence process is conducted to even the financial model and the way we're going to be evaluating the financial component of the application packet as close to a traditional investment process as possible. Again, one of the objectives of Spark is to really be the kind of final hurdle in helping cook stove enterprises and clean cooking enterprises get to investment readiness. So whether you're applying under the venture category, under the growth, or under the growth category, all of the materials are designed to be as similar to an investment process as possible and really help you prep for that. So with that, we really would like to reemphasize, don't customize things for Spark. Do the financial model as you would do it if you were applying for, if you were presenting this application packet to investors. So don't try and guess and game the system and guess what the Alliance is looking for based on objectives, et cetera. Just build the best application package and business plan you can and financial plan you can for your business, something realistic. Because as we're digging down and analyzing it, we'll be looking at it from an investor perspective, and in particular during due diligence. So anything that doesn't really sync with your reality and with a credible strategic growth plan will come out when we're doing the further analysis and in particular the due diligence in phase 2 for any of the finalists. With that point, it's important to mention that if you have a financial model that's already been developed for your business and you think it's better than the template that we've provided, by all means, go ahead and use it. A model that you've slaved over or hired someone to work on that is customized for your business may tell your story and may be better customized than the model that we've put together. The model that we've put together for this is a standardized template. And as part of that, it had to kind of be applicable for multiple different business types. So again, if you have a model that you spent a lot of time putting together and you think is sound and represents your business better than the financial model or template that has been provided, go ahead and use that instead. That being said, there are a few minimum criteria that we need to see. I'll actually flip to the next page to go into that, and then I'll go back. For everyone, we need to see historical financials, regardless of whether you use the template provided or your own. We'll need to see historical financials. That's P&L, so income statement, balance sheet, and cash flow statements for the past 2 or 3 years. Audited is better, but if you don't have audited, that won't necessarily count against you. So historical financials for the past 2 or 3 years, audited or unaudited. For forward-looking projections, again, we need a minimum of 3 years for that, and it's income statement, balance sheet, and cash flows. If the model, if you are using your own model and it has more information and goes more in depth than the model, than the template we've presented, go ahead and feel free to use that. But if it's not, the major line items or sections you see are missing that are included in the financial template provided, then make sure that you add them to your model or use the template, because we will be evaluating the businesses based on each of the sections provided. Additionally, it's important to note that in the financial model template, we've included a summary chart that should be copy and pasted into the executive summary. This is important for anyone who's using their own model as well. You can use your own summary chart. But we do need all of that information that's included in the summary chart in the template that we've provided to be copied and pasted into the executive summary, so that way when the judges and people doing the evaluations are reviewing the executive summary, they have a better context. Let me go back one page and take a step back now really quickly and describe from a more macro perspective what we're looking for from these models. So what's from the financial section. So what's the difference between a thumbs up application and financial model and one that we think may need some work or some adjustment or might not make the cut? First off, and most importantly, a realistic, credible growth plan. We see models all the time, and investors see financial projections, forward-looking projections all the time that have businesses going from, $2,000 of revenue and barely post-pilot to $15 million within 2 years. While that can happen very rarely, it's probably not likely. So be realistic with your projections, because again, we're going to be taking a very critical eye, and the people who will be evaluating these financial projections see a lot of businesses in very similar situations. So don't shoot for pie for the sky, kind of anticipating what the evaluators want to see. Be realistic in your growth projections, and develop plans that, as you're getting questioned on them during due diligence, you can back up realistically. Again, another key component of Spark is commercial viability. That doesn't mean that you have to be profitable right now at application. And there's slightly different understanding of what commercial viability is for whether you're applying under Spark Venture or Spark Growth. For Venture, it means you need to have a credible plan and show that plan within your financials, within your financial projections. You need to have a credible plan for achieving commercial profitability and viability in the medium term, so within 3 to 5 years, and something that's realistic, feasible, and achievable. It doesn't need to be by the end of the Spark period, though. With Spark, it's a little bit, with the growth category, it's a little bit more stringent. We would like to see, if not all the way to profitable, to profitability and commercial viability, getting very close, with maybe one last little bit of investment or small additional push in sales, et cetera, to get there. We want to see businesses, especially for growth, that are turning the corner. One of the main things we'll be looking at for growth are businesses that, after this Spark funding, will be able to bring in $1 million, $2 million, et cetera, the larger amounts of funding from later stage investors, from traditional impact and financial investors. Again, that's one of the key focuses and goals of the Spark Fund, in particular for the growth category. So we do need to see in your financial plan a focus on that and a real credible ability to achieve that within the life of the Spark grant, or at the very end of it at the latest. We also need to see and make sure that you discuss your resources to date, so what funding you brought in, both grant and investment, grant investment and debt capital, what your company capitalization looks like, so who owns what shares, what types of shares they are, et cetera, and a sound investment strategy. That includes appropriate CapEx to achieve your growth plan, as well as use of funds for Spark Grant that are in line with achieving the plan. If your plan, if your financial projections are reliant on investing in a new factory to hit that, to turn that corner and hit break even and profitability, but you don't have those numbers flowing into your investment, your use of funds, or future CapEx, then that's going to raise some flags, because it'll show that your growth strategy really needs a significant amount of additional capital that isn't accounted for in your projections to be successful and to be achievable. So again, you're hearing me mention achievable and credible a number of times on this call. One final thing that we get all the time that I'd like to stress is, please, and Patrick will go through this as well, both in the executive summary section of the application at the very end and in the model itself, please make sure you describe any key drivers unusual numbers or variances. So if your revenue pops significantly in 1 year from 1 year to the next, or if your margins improve considerably, describe why. Otherwise, it's very hard for someone reviewing it without that insight and information to understand it, and it may cause room for concern and cause the evaluator to question the feasibility and credibility of it. So please make sure you over-explain any major changes in your any major beliefs or changes in the numbers as you look across. One thing that I tend to do when looking at financial models or developing and presenting financial models is once it's all done, take a step back and do a sanity check, either yourself or someone else. Print it out, review it, and say, do all of these numbers make sense? Do the numbers in the P&L, do the numbers in the balance sheet, do the numbers in the cash flow statement actually make sense? Get out of the individual line items and say, okay, my revenue growth from year to year to year is in line. It's not, there's no huge upticks that are unexplainable. There could be, but that means that you're doing some investing or doing something differently from 1 year to the other. Your margins are all smooth, or there's explanations behind them, your cash flow balances, etc. So do that. Really, it's very beneficial to take a step back and do that sanity check at the end of doing any financial model. With that, I will pass it off. I'm actually going to change the share screen now to pull up the financial model itself. And Patrick will go through the model step by step. Patrick?
Excellent. Thank you very much, Jason. Okay, the financial model. So I'm going to go through every single tab of this financial model. Now, as Jason mentioned when he was introducing it, one of the things that we've gone for is we're not trying to replace the financial models that businesses have in place, but we're trying to make sure that the financials that are presented are to a minimum level that will withstand a certain amount of investment appraisal, a kind of preliminary screening by an investor, and stand up to a breakdown of assumptions, and they'll actually have to think through all of the different aspects of their income statement, their cash flow statement, and their balance sheet. So with that in mind, let's start with the first page. Oh, just very quickly, can everybody see the financial model that I have up on my screen?
Everybody is muted, but we can see what you have on your screen, Patrick, so go ahead.
Okay, thanks, Stevie. So starting with the first tab, I mean, if you look at this financial model, it can look quite scary to start with because it's 7 tabs, but I just want to say only 3 of those tabs are actually input tabs, or proper input tabs. The remaining tabs are either instructional tabs or output tabs. So it's really not as scary as it actually looks at first sight. So on the first page, on the cover page, on the cover tab, you put in the name of the organization and the Spark Fund window that you're going through. Is it the venture or the Spark Fund growth? Next, it's pretty self-explanatory. Going on to the next tab, we've got a really high overview of the instructions, how to fill in the financial model. And this effectively covers off, if you look at the bottom, we've got the legend. The legend shows you what the different colors of the boxes are. I mean, as you can see, there are 7 different colors of boxes, telling you whether you've made an error, if the information provided is correct, if it's an instruction, if it is something that needs to be filled in, that's the name of something. So it allows you to understand what all those different colors mean. And then a little bit above that, points 1 to 8 provide you an overview as to how that model actually fits together. So if we go to point 1 is one of the key drivers behind this model. You select the country of operation. Now the country of operation determines all of those macroeconomic assumptions that come down in rows 18 to 23. Now those macroeconomic assumptions are currency, effectively interest rates and tax rates. That's what it all boils down to. So you should, if you have, just giving you an example, if you have a head office in the UK and your operations are in Ghana, and so your operations are in SETI, but you do a lot of your procurement in the UK, you've got to think which currency, is it the SETI or the pound, which currency affects your business the most, and it's that currency that you select to fill in this financial model. Okay? Now what happens is you'll select a currency, so let's pretend that we're in Argentina. So it gives us the Argentinian currency. Now, that's assuming that you're operating in Argentina. If some of these rates, some of these assumptions aren't totally applicable to your business, so for example, here we have lending rate of 17% and a deposit rate of 12%. Now they're quite high because these are general assumptions about the Argentinian economy. If you're able to get interest rates at a lower rate than that, or the corporate tax rate that you're paying is lower than that, then what you do is you can manually override it in cells I-19 to I-23. And that will effectively allow you to lower the lending rate, or increase the tax rate, or change the currency that's impacting your business more, so that you're able to make this a little bit more bespoke depending on where your business is operating and what's actually impacting your business. That's the Instructions tab. Moving on to the Commentary tab. Now the Commentary tab is something that Jason alluded to in his discussion of the financial model earlier on. The Commentary tab goes through several main areas. It covers off the sales and expenses, the assets and liabilities, the financial summary, and the executive summary. And as you can see, those different categories relate to the 4 subsequent tabs in this financial model. So what this allows you to do is this allows you to put in general commentary on the financial model. So for example, sales and expenses, rows 14 to 20 allows you to put in general commentary on what's happening in the sales and expenses tab.
Now that commentary, really quickly, isn't I didn't understand this or this didn't work. It's more, what are the key drivers behind it, correct?
It is. It's key drivers behind certain elements. Now, specific drivers for specific line items are covered in rows 32 to 39. So for example, if you have revenue, let's use 33, COGS and operating expenses. So what you quite often see in high growth businesses is you see a significant drop in COGS per unit as they grow and they achieve economies of scale. Now, I'm looking at a business and it's growing 2013, 2014, it gets $200,000 in sales, $600,000 in sales, and then 2015, we suddenly jumped to about $1 million in sales. And their COGS per unit drops by about 50%. Now, there is nowhere in the subsequent tabs, in the sales and expenses, or the assets and liabilities tab, that will tell me what that drop is for. So it is up to the person filling in this financial model to put in the commentary as to why those COGS have dropped. It could be economies of scale, it could be because you're bringing your manufacturing in country, it could be for a whole range of reasons. But we'll need you to tell us the story through this commentary section of what's happening in your historical and what's happening in your forecast financials, okay? So that's a really, really important thing. 32 to 39 is for the sales and expenses tab, for the specific drivers. 62 to 67 is for the assets and liabilities, effectively the balance sheet tab, okay? So just be aware of that. And then the remaining boxes, as Jason mentioned, are the general assumptions tab, the general assumptions line. So moving on to sales and expenses. Now the revenue is done in a number of different ways. We've given you a few options depending on your level, the level of clarity that you have with financials of your business. So there are 2 ways in which you can do the revenues. The first way is cell C11 to C18. You need to fill in all of the goods and services that your business provides and is intending to provide over the forecast period. So you put in the goods and services and you put in the number of goods and services sold per year, per good or service. And that will go in cells D11 to I18. Now the second piece that's required to get to the full total revenue is the average price per good or service. So for example, if you have, in 2013, you sold good service 1, we're going to call stove 1. So you sold 100 stoves and you have an average price per good of $10. Then you're going to end up with $1,000 of revenue. Now, if you're not totally sure what your average price per good was in 2013, because it changed from $7 to $9 to $15, $20, and you're not entirely sure what it was over the whole period, what you can do is you can go down to rows 31 to 38, and you can put in the entire revenue broken down by that particular good and service. And that allows you to total up your total revenue either through the number of goods and services per unit times the average price, or the number of goods and services sold times the total revenue per goods and service. Okay? So you do box 1 and 2 or box 1 and 3. If you do box 1 and 3, it auto-populates the box on the right-hand side of the screen, which is this box. I can't highlight it because it's protected, but effectively the box from T21 to U28, and that is effectively used for our internal analysis of the business. When we go through the analysing the business, we're going to effectively pick apart all of the assumptions that have gone into this financial model to analyse it as an investor would analyse the business. And so what happens here is in the box from P onwards, it allows us to analyse the business on a per unit basis.
It's important to note also, I know there's a lot of information coming through right now. All of this is also described in the boxes, the pink boxes on the right-hand side. So you get comprehensive descriptions in the pink boxes that reiterate what Patrick is going through in those pink boxes on the right-hand side.
Yeah, that's completely true. So that's an important point. It's quite a comprehensive explanation of what's happening in each box on the right. Moving down from the revenue to the cost of goods sold, we've taken a fairly similar approach to that. So there are two ways in which you can do this as well. You can do your cost of goods sold broken down by cost items. And when I say cost items, I mean, what are your cost items? Your cost items will be raw materials, labour, effectively the breakdown of the costs that went into making your products. And you can break it down that way. If you don't have that breakdown, as I know a number of businesses like to break it down like that, and a number of businesses don't like to break it down like that. If you don't have that breakdown, then you can move to cells or rows 53 to 60, and that breaks it down by your goods and service. That effectively allows you to put in what was your cost of producing goods service 1 in 2012 or 13 or 14. And then that effectively allows you to come up with your COGS broken down by your goods and services. If you have it for both, so if you have it for your broken down by cost items and your broken down by revenue items, I would suggest, and it's a really good exercise, but I would suggest you put in both. And what this model actually does is it has a check balance in row 63. So the total of both those boxes should add up to the same thing. The total of all of your COGS should add up to the total of all of the costs of your goods and services throughout that year. If it doesn't add up, row 63 will come out with an error balance. Now, one of the things that's important to point out throughout this entire COGS section, which is explained on the right-hand side, is you need to remember to put in all of your figures. If it's an expense figure, all of your figures as a negative number. Otherwise, it'll come up as a red cell and it will flag it up as an error. Okay, just as a warning. So the subsequent boxes, sales and marketing, admin expenses, personnel expenses, other ongoing operating expenses, are all fairly self-explanatory, and there are examples of what they should be over in the boxes on the right. So sales and marketing, publicity, it can be publicity or commission, for example. Admin expenses can be office supplies, telephone. Personnel expenses, one note about personnel expenses, it's obviously labour, but it's labour that's not directly employed with the production of your products. So, for example, if you have a production line, all of the labour costs that go into that production line should be sitting up in COGS and not down in personnel. Your personnel, for your admin team, or for your management team, or for anybody that's not actually producing a product.
Where does sales and marketing personnel go? Do they go in sales and marketing, or do they go in personnel?
Sales and marketing will go in, I would say sales and marketing expenses will be direct sales and marketing expenses, so people so organizations you're paying, or it could be commission that you're paying directly for commission. But I would say actual core wages will go into personnel expenses. Okay? Moving down, we get to depreciation and amortization. Now, depreciation and amortization, I'm going to leave until the end to explain that, because that comes into that comes in line with a couple of the other elements. So going into the other items section, we've got your one-off or exceptional revenues expenses, and we've got your non-operating revenues expenses. The one-off or exceptional revenues or expenses are, exactly what it says. They're one-off revenues or expenses. This is to cover both revenues and expenses. Revenues is positive, expenses is negative. A one-off item could be, for example, if you get a payout from a supplier, for example, that reneged on an agreement that they had with you, and they had to give you a payment for litigation or something like that. That is not something that you're expecting to receive on a recurring basis, so that would go into your revenues.
Selling equipment, piece of equipment.
Yeah. That's a good example as well. Or selling a piece of equipment that's in the factory. You're not looking to sell all your equipment every year, so that's a one-off or exceptional revenue. Additionally, if you're restructuring your business, expenses will go into this. Non-operating revenues expenses would be things that aren't directly related to your core operations. So, for example, if you've got carbon revenues, some people, that could be a part of their core operations. I would say for the majority of businesses, it's a non-operating revenue. If you're selling stoves that generate carbon revenues, your general revenues are the stoves. Your non-operating revenues are the carbon revenues that you get the offsets for.
This is an important point to note here, that under this model and in the executive summary and application in general, what should be classified as revenues. There's revenues from direct sales of products, whether that's cook stoves, fuels, pellets, etc. There's revenues from carbon credits, which should not be counted for, in the most cases, as direct revenues. But in this other non-operating revenue section, grant funding should not be calculated as revenues. Grant funding that you've received from organizations like GACC, from other development agencies, etc., should not be counted as direct revenues in the first group, but rather go into non-operating revenues.
Yeah, that's exactly right, Jason. Okay, so finishing this page, I'm going to lump depreciation and amortization, interest paid on debt, interest received, corporate income taxes paid. They're all income statement items. However, because they're going to be driven by a lot of the balance sheet assumptions in this model, you only really need to put in, if you have forecast numbers, put forecast numbers in. If you don't, you only need to put in your historical numbers, and the assets and liabilities tab will generate the forecast numbers based on your historicals and the assumptions you put into the assets and liabilities tab. So, for example, 104 depreciation and amortization. You put in your financial statement 2012 and 2013 numbers. Your 2014, 15, 16, and 17 numbers will get generated by this model. If now we're in 2015, if you know your December 2014 numbers, please put them in. But if you don't have them, don't worry, they will be generated by the model. So that's not an essential. It's not an essential thing to enter into the model. It's just a nice to have. So moving on to the next tab, which is the assets and liabilities tab. Now, I realize this to a lot of people looks like the most complicated tab. It is, surprisingly enough, actually the simplest tab. It's the most intuitive of all of them. So we're going to start with this first section. Now, rows 9 to 13, average number of days required to collect payment after sale, average number of days good to held with inventory, average number required to make payment after receipt of inventory. They're all effectively helping to determine what your working capital cycle is. Debt outstanding as of today, cash level as of today are balance sheet items, and they go directly to your balance sheet. So those top 5 items, you are to leave those items until you've completed the rest of this page. Because what those items do, so what rows 9 to 13 does, is, so for example, for row 9, average number of days required to collect payment after sale, it'll take your forecast revenue numbers and it'll calculate how many days after you've made that sale are you then going to receive that cash. And that helps to determine your cash flow statement during those forecast years. it benchmarks all of these numbers against your historical numbers. So, for example, it'll benchmark it against what you put in for 2012 and 2013, and it's for that reason you need to do all of the rest of the sheet first, and then put in your assumptions for the future, and it will come up with a message which is effectively saying your accounts receivable days are significantly lower than what they've historically been. Are you okay with this? It'll come up with an alert message if they're significantly different to your historical numbers. It's not necessarily it's an error. It just wants you to make sure that your assumptions that you're putting for the future, you know what you're putting in and you believe in those forecasts. So moving down to the cash flow movements, which is row 15 onwards, we've got effectively changing cash coming into and going out of the business from a capital structure point of view. 18, 19, and 20 covers your debt raised, debt repaid, equity raised, or grants received, and your capital expenditure. And this is from a historical point of view. Rows 22 to 30 looks at what are the assets in place at the end of the last fiscal year. So C23 to C30, you put in the name of the asset. E23 to E30, you put in what are the remaining accounting years on that asset, and the reason being is because these numbers are used to generate your depreciation. So it's not, for example, if you have for example, like a corn grinding machine, that in reality will last for 20, 30, 40 years. Its accounting life may well just be 10 years. So you put in 10 years rather than 20 to 30 years because it's not the 30 years that generates your depreciation, it's what the accounting treatment is within that country. So for example, C23 we have corn grinding machine, E23 will put in 10 years, we'll then put in what was our original purchase price for it, when was it purchased, and what that will calculate is it will tell us what is the balance sheet going to look like at the moment in this current year, and what is our forecast depreciation going to look like. Then we go on to row 32, and that is looking at assets purchased this fiscal year or in the future, and that's effectively saying for you to grow, so this is your use of funds, for you to continue growing moving forward, what assets do you think you need to grow the scale of your business, increase volume that you're selling? That might be a new machine, in which case put it in here. You might need a bigger corn grinding machine. Put it in there. What's the useful life? 10 years. It's going to cost you a significant amount of money, and it's going to last, and you'll be looking to buy it in 2050. That is part of your uses of funds. So use it to help explain to the people reading this model what you're intending to use any funds that come into the business for. Then we move down to row 42, which is debt outstanding at the end of last fiscal year, and this is just covering off balance sheet items. What is the debt that you've got at the moment? Do you have a balance with Equity Bank or with a bank in the US or somewhere else? What is the interest rate? What is the amount outstanding? When does it need to be paid back? From that information, we can calculate what is the amortization, what is the cost to the business over the forthcoming years from having to pay that back in line with the maturity. 48 onwards goes to debt financing raised this fiscal year or in the future, and that's effectively saying how much you're intending to raise moving forward. So if you need, for example, if you're looking for an investor to help you buy that corn grinding machine in cell C33, you might be looking to raise some debt for that. That debt would go in C49. And you can put in what your assumptions are for what the interest rate is. As you can see here, because we've got, just going back to the instructions, as we put in Argentina, it's come up with what is the interest rate for lending in Argentina. So that's populated the cells here to say if we want to borrow some money for our corn grinding machine, it's going to cost us 17% a year. That may not be the situation with your company, in which case you need to go back to the instructions, you need to override in I-21, and it'll change the amount that you'll be borrowing at to actually raise those funds in the future. Moving down, we get to the equity rate, and that's effectively the same as 48 to 52, but it's just saying, what is the, if you're looking to raise equity instead of debt, possibly to fund some of your growth, then you'd stick it in 55 and 56. Moving down, these rows 60 to 65 and rows 69 to 71 are just covering off balance sheet items, historical balance sheet items. Again, as with the depreciation, if you have those numbers moving forward to the forecast period, feel free to put them in. If you don't, the model will generate those numbers for you. So, for example, row 61. Let's get a row 61. Row 61, accounts receivable, 2012. Put in your financial statement number for accounts receivable, same for 2013. And then when you populate your numbers, after you've done all of this, once you populate your numbers here, it will forecast forward all of these balance sheet numbers in these cells from G60 to J66. So that is the Assets and Liabilities tab. Moving on to the Financial Summary. The Financial Summary is just, you don't need to do anything on this. It's populated from all of the entries you made in the Assets and Liabilities, Sales and Expenses, not commentary, and Instructions tab. And so it's coming up in Argentinian currency, and it's effectively populating your income statement, your cash flow statement, and your balance sheet. So all of the primary statements that an investor would look for when they're looking at a business. In addition, at the bottom, we've got performance metrics. And those performance metrics are to allow us, when we're going through analyzing this business, how is the business performing? Is its gross margin improving? How's its EBITDA growth? Looking at its free cash flow, is it positive, negative? Is it increasing, declining? How's its net debt looking? Is it increasing its leveraging? So it allows us to look at this from an investment point of view. The last tab effectively takes the Financial Summary tab, and it just it does exactly that. It summarizes it. It summarizes it into some very, very basic details that you will need to copy and paste into the financial overview section of your executive summary. So I think that pretty much covers everything in the financial model. So I think this is over to you, Stevie.
Thank you, Patrick. That was incredibly helpful. And we already have a few questions coming into the question and answers button on top, as well as a chat box to the left. But maybe I just wanted to cover one point before we jump over to the questions. And that's just clarifying the two stages of review for the Spark Fund, because I think both Jason and Patrick, you're mentioning what we are going to be looking at as the Global Alliance and what we are going to be reviewing. But I wanted to remind, getting an echo here.
It's us, Stevie. We'll put him on mute.
Okay, thank you. So I just wanted to remind people that there are two parts to the review process. So once Spark Fund applications are submitted on January 30th by 6 p.m. Eastern Time, we will have a sort of set of probably about 5 reviewers looking at your applications for the initial phase, and then we'll choose up to 20 enterprises to go on to the due diligence phase. So those first 5 reviewers will be taking a close look at the financials for some basic indicators that fit in with the evaluation criteria. And then this due diligence phase is where you're going to see the IDEV team, Jason, Patrick, and his colleagues really taking apart all of those assumptions, which is why it's a good idea to do your homework now as you're really thinking through what you're going to put into this model, how you want to grow, and what your assumptions are. So maybe with that, I'll just go to the first question here in the chat box, which is from Shannon Murphy. She asks, should grants received be put into the non-operating revenue on the sales and expenses tab, and then again into the equity raised or grants received on the assets and liabilities tab?
Great question. Great question, Shannon. Grants received should be put into both the income statement and the balance sheet. So do include them in both, because one's going to populate the balance sheet and kind of current and historical, and one will populate the income statement. Your forecast grants will mainly be put in, forecast grants that you think you're going to be receiving over the next 3 years should mainly, well, there is only really a place to put them in the sales and expenses tab. Does
Right.
that answer
And
the
they
question?
should include Spark, right?
So what's that question, Stevie?
They should include their Spark grants. I think we've seen that in the past
Yeah,
where they actually didn't.
That's exactly right.
Great. So let's move on to the next question that came in through the Q&A tab. This is from Ben. He asks, is it correct to say that Spark is only looking for ventures that provide investment opportunity for international capital? That is to say, many organizations building stoves are prohibited by law from paying returns to investors. So the Global Fund is removing stove building from the primary organizational model of developing world communities. And I think this is mostly attributing to this nonprofit versus for-profit question, but Patrick and Jason will maybe let you take a stab at it, and I can follow up with any additional comments.
Yeah, I think, Stevie, and this may be something that you would want to chime in more on, but again, GACC is looking to promote commercially viable entities and enterprises and organizations, and part of that is a focus on actually being able to scale and get to the much larger numbers of 500 million, 100 million, 200 million, 500 million people with cook stoves. If there isn't a commercial, that's much harder to achieve without a commercially viable option, because that just means you need more and more grant capital to provide more and more stoves. I think one of the things that GACC would like to do with Spark, and Stevie, correct me if you have a better nuance to this, is help support the entire cook stove and clean cooking industry, so fuels and payment systems, et cetera, as well, to get to the point where they are commercially viable, where the businesses in it are commercially viable, but the sector as a whole is commercially viable. A large number of those organizations will be for-profit businesses. But that doesn't mean that nonprofits are completely eliminated if they have a for-profit subsidiary that they're doing this under that's been operating and proven and successful, if they have within the nonprofit structure a commercially viable mechanism for selling whatever product it is that they're working on, whether it's cook stoves, fuels, etc. So there are nonprofit, university, etc. opportunities. Should not necessarily be excluded, but they do need to have a market-based, commercially viable approach.
Thanks, Jason. I think that's actually incredibly helpful and well said. So in terms of the legal structure, whether you're for-profit or nonprofit, in terms of the Spark Fund, we are looking for financial viability in the long term, mostly because we can't guarantee that we'll be able to continue supporting your organization as you grow and scale. So that's why we look for the long-term viability as well as the investment potential. With that said, on the investment potential side, there are nonprofits that can take out, for example, debt funding as they need to grow or something similar. So again, we've actually conducted due diligence on nonprofit entities for the Spark Fund. We've granted the first round of Spark Fund, which was quite different, to nonprofit entities. But I think as we continue to look at this financially viable model, we consider it as important to think about too, how many grants will you need to get to that point of viability? Are you going to need to take on debt as you continue to grow, and how can you be able to service that debt? Mostly because we want to see that the organization is strong and going to continue to keep moving on, particularly in the out years when the Alliance is not able to directly support the organizations. So with that, I think we only have a few more minutes, so I want to jump over to the next questions. This is from James. He talks about most of his historicals relating to R&D cost, IP filed, and prototyping. And he has projections, but he's concerned about moving forward with the grant application considering the emphasis on historical. So I think this is going back towards if they're sort of a new organization or they've only been working on developing their product and some initial piloting, does it make sense for them to apply?
I'll go ahead and take that, Stevie, and chime in here, but I would say probably not. Spark is generally for later stage organizations that have already done significant proof of concept and gone to market and are turning the corner towards, profitability or getting close. And there is some difference between Spark Venture and Spark Growth. But in any case, the businesses need to be generating significant amount of revenue. The venture range, and this is not an exact range, but it's somewhere between $100,000 and $500,000 of revenue. More or less. Again, it's not exact, and the growth range is between $350 and several $1 million of revenue. Spark businesses can also be on the other side. They can be too commercially viable and ready for Spark, meaning they don't need additional grant support to continue to grow. They can get access to traditional either impact investor or bank or other investment capital to grow and scale. That's fantastic, and what we all want to see happen. But on the flip side, there are several other, on the earlier stage side, the GACC has several other programs for supporting early stage businesses. There's Catalytic Small Grants Program, there's the Pilot Innovation Fund Program. The Spark program is probably not the best for earliest stage organizations.
Jason, maybe I'll just add a little bit of a nuance to that as well. So I think one thing we do recognize is that there is a little bit of a space between when you're sort of post-prototype or post-pilot, but not really showing a lot of sales traction. And so what I would say is if you're still very much in this prototyping stage or sort of tinkering with the product or the business model itself, I think Jason's absolutely right. However, if you've already begun to sell product and you're showing sales traction, but maybe aren't to that $100,000 revenue tick, I think that it's still worthwhile to go through this exercise because we have at least looked at these companies in the due diligence phase for Spark Venture. They haven't been competitive in the past, but we don't know if they're going to be competitive, in this round, for example. So there was actually a very good example of a Spark Venture application who had spent quite a bit of time piloting and really hadn't reached much in terms of revenue and just sort of lost out because it was a little bit too early stage. It doesn't mean the due diligence wasn't valuable, and it doesn't mean that the process of going through this planning wasn't valuable. And honestly speaking, if there were enough grants to give, we might have given that entity a grant just to get them past this early stage, and they could come back later for a Spark growth application. So I think that's something to keep in mind. It is a lot of time to invest to go through this process, so just think about it carefully. If you are a much smaller entity, as Jason mentioned, and you're in a focus country, I would talk to your market manager about the Catalytic Small Grants Program to see if that's an option for you. We are just over time now, so I think I'm going to jump over to these next questions. The next question that came in is from Charlie. He asked how many grants will be issued. So Charlie, I'll go ahead and answer this one from the Alliance perspective. So the grant fund is $2 million. And in the past, we've supported at least 5 entities with $2 million, but it comes down to the end, who are the strongest applications, how many of those are growth versus venture, and how much money do they need exactly. So that $2 million is sort of split by 5 to 6 entities. If possible this year, we hope to do a bit more than 5 to 6. and leaving some room for those earlier stage companies that are maybe only needing the $100,000 range from Spark Venture, which is $100,000 to $300,000 award. So it really just depends, but keep that in mind. Last year we did 6. And then we do have one question here from Shannon, and she asks if we have our own financial projections but they don't include historical performance, could we submit them in addition to the Spark template? So I'll let Jason and Patrick go ahead and answer that question.
Cheers, Stevie. I would say if you have your own financial projections and you think after what I've discussed earlier, they're comprehensive enough or clear enough to present as part of your Spark application, I would, instead of doing the financial model as well, I would just insert some columns into your financial model for your historical numbers and just add in some income statement and some hard codes and income statement and balance sheet historical numbers, rather than creating a totally separate model in the Spark financial model. But that's what I would do, because I don't think it wouldn't make life any easier for you having 2 different financial models, and it would also make life a lot easier for the person reviewing it, having the numbers all included in one financial model.
And again, some of this is, there will be 100 plus applications submitted. So it's whatever you can do to present your business in the best light. And as complete and comprehensive information as possible within the parameters of the application, right? Quality, not quantity, is the key here, and that's evident in the 5 to 6 page executive summary limitation as well. So whatever you think and whatever format and way you think will represent your business the best, you should go ahead and go with.
Yeah, totally agree.
Great. Now, for those of you that do have to leave, or we had planned to leave at 9:30, please, if you need to, go ahead and leave the call. We will have this again online tomorrow, and you can listen to the last section of questions and answers on our YouTube page. But I will keep going for those who have additional questions. So I did have one more comment from Joseph. He asks, are there 20 applicants only who will be benefiting from this round? And maybe, Jason, I'll take a first stab at this to talk about the review process, and then you can go ahead and add any clarifications to this. So in terms of the question, I think I'm understanding it correctly. There are only 20 that will go to the due diligence round, and if this Spark fund is anything like the last year's Spark fund, we end up having around 70 or so applications that are actually submitted. 50 or so of them are pretty complete and really viable to move on to that review where you sort of see 5 reviewers. Like all of the people who have complete applications and review it basically, or get it reviewed, will receive a SWOT analysis of their application and feedback on their application this year. So we'll pull all of the comments from those reviewers together into an analysis of your business and model and feedback on that. So it is worth it in terms of getting feedback on your business plan, on your financial model, because if you submit a complete application, you will get that feedback. So of those 50 or so that are truly complete applications and that are reviewed, 20 of those are actually going to due diligence, which we see is a beneficial process in of itself to get the iDev team and Innovent team who are partnering with them on this to really take a critical look at your company. They provide you with a lot of feedback in a due diligence document, and you get a lot of sort of third-party look at your business. And I've actually been on some of these trips where the enterprises have said that, they've really given us some interesting ideas and really taken a good look at things. So I'll pause there. Maybe you see if Jason or Patrick have anything to add to that.
I would agree. I think, Stevie, you covered most of it there. I think everyone who applies can benefit from the process. I think even if you don't apply, if your organization isn't ready to apply, again, one of the things that we were charged with by both the Alliance and also in kind of doing the 360-degree review of previous Spark, PIP, and other program stakeholders was that the application materials could be used as a really valuable tool for strengthening a business regardless of whether or not the organization is selected. And I think that goes even further, even if you decide after this call that maybe it's not the right time for your organization for one reason or another, some of the materials in there, if not all of them, the executive summary template, the financial model framework, the growth strategy framework, et cetera, were designed to be valuable tools in helping manage and grow your business. So whether you end up applying or not, take a look at the materials and see if they're relevant and helpful for you. So I think, again, the benefit could go well beyond, as Stevie, well beyond the 20 that are selected for the due diligence round. And as Stevie mentioned, every business that applies and has a completed application will receive feedback from the evaluators and in-depth feedback from the evaluators.
Great, thanks. And thanks for staying on the call, Jason and Patrick. I know we're going a bit over, but I did have one question just come in, and that's around the assets projections. Rodrigo asks, for the assets projections, do we have to consider as if we get the Spark fund? And I think we discussed that, but I'll go ahead and have you answer again.
Thanks, Stevie. The asset projections are it's effectively, in a perfect world, what would you look to achieve if you had access to the money that you wanted access to grow in line with your objectives? So that means that yes, you include the acquisition of assets to help your business expand and scale, because by including that, you're allowing us to see where you're going to use funds to help your business scale, and it provides us information to help analyze the risk of that growth to your business as well, and how achievable that growth is. So the answer is yes. Included.
Great, thanks. And I did have one question come into the investment email last night related to the financial model, so I'm going to take advantage of having you on the line to ask that question. I think it would be valuable for others as well. So this comes in from Nicholas. He asks, under the sheet instructions, item 1, applicants are required to indicate the currency in which the business operates and requires local currency. And in his particular country, Ghana, the CD is volatile against the dollar, and he wanted to ask if it's okay to present these figures in the U.S. dollar.
Yeah, and so I tried to, probably not very well, go through this earlier, but you should present, because I know we've done quite a bit of work in Ghana, and the study's been volatile for the last 18 months. If you want to show your operations in dollars, that's fine, but you need to show the volatility of the SEDI in those dollars. So, for example, I'm going to just give you an example. Let's say I'm selling a stove for the equivalent of $50 in Ghana at the moment, and it's, I don't know what the rate is, let's say it's 3 SEDI to the dollar. I think it's 2 SEDI to the dollar, okay? So that's 25 SEDI. Now, if the SEDI goes down to being 6 SEDI to the dollar in, let's say, 12 months' time, then effectively in dollar terms, the amount that I'll be receiving in dollar terms will go down significantly, because the SEDI, which I'm selling my stove at 50 SEDI, or whatever the price is, or whatever the price is, will be worth less in dollars. So that needs to be reflected in the financial model moving forward. If you're generating your revenues in a local currency such as SEDI, and you're representing your revenues in a currency, an international currency like the dollar, you need to show the currency fluctuations. If you're going to keep your prices stable, you need to show what kind of risk that implies on the business. And in this case, it would mean that the revenues for the same amount of units and for the same price of SEDI would be worth less in 12 months' time than it is today. Does that clarify for you, Stevie?
Yes, that's helpful. That's what I thought. I just wanted to be sure and make sure that we give a good answer to all of those that are operating maybe in more volatile currencies. So great. I think with that, we have answered all of the questions that have come in. I want to thank Jason and Patrick again for your time. I know you've already spent quite a bit of time with us on Spark Fund and Pilot Innovation Fund, but I think this is very helpful, and we had some really great questions come in. So thank you again for your time and your presentation. As a reminder, up on this thank you slide that you'll see in this webinar, you can send any follow-up questions to investment@cleancookstoves.org. Anything related towards the application workbook or financial model, we also sort of flag those questions for IDEV to make sure we get the person who actually designed those models and workbooks to answer those questions as well. We do have a frequently asked questions page, and just please make sure you complete your application. As Jason and I alluded to in the past, there's more often than not quite a few cases of people who submit an application that's not quite complete, and it causes a lot of challenges for us, and quite often you don't get the review and the feedback that you should be getting to really help your business move forward. So this slide is a bit out of date, but we will be getting those 15-minute segments on the application workbook and platform up by today. There might be a little bit of delay, but other than that, I want to thank you all for your time and your questions, and we wish you really the best of luck as you fill out your Spark Fund applications, and we really do look forward to reading your business plans and learning more about your enterprises. Thank you again.
Thanks, everyone. Thanks, guys.